If you're getting close to buying a home, you know it's probably the biggest financial decision of your life, and then you're hit with this alphabet soup of mortgage types: FHA, VA, jumbo, conventional.
It's overwhelming and a little intimidating, frankly.
It really is. So today, we're doing a deep dive into some sources from a premier mortgage company. They've been operating in the Coral Springs, Florida market since 1996, so they've seen a thing or two.
And our goal here is to be your guides through this. We're not just going to list off loan types. We're trying to pull out the hidden keys to a smaller mortgage payment that this material keeps talking about.
Right. It's about looking past the headline interest rate and getting into the real-world factors, and also the regulatory stuff that shapes these loans for people like you.
Exactly.
Okay, so let's unpack this. Where do we even begin? The sources seem to want to categorize things right away so you can figure out where you fit.
That's the best place to start. And the foundation really is the conventional loan.
The one you always hear about.
It's the one you hear about. These are the mortgages that have to meet the standards set by Fannie Mae and Freddie Mac. They're everywhere. They have competitive rates, but, and this is a big but.
That's always a but.
The best rates are really for borrowers with excellent credit and a pretty big down payment, I think 20% usually, to avoid paying what's called PMI, or private mortgage insurance.
So conventional loans are kind of the gold standard, but for a borrower who's already in a really strong financial position?
That's a good way to put it.
So what about, the millions of people who don't have perfect credit or a huge pile of cash sitting around?
Well, that's where the government-backed programs come in. They're specifically designed for broader accessibility.
On the FHA loan.
Exactly. The FHA loan, it's insured by the Federal Housing Administration. And what really stands out in the documents is that these are meant to, democratize homeownership.
So perfect for first-time buyers. People with okay credit, but not stellar.
Yes. They make it easier to get in the door. You might only need a 3.5% down payment. The trade-off, though, is that you almost always have to pay mortgage insurance, and that gets added to your monthly payment.
Okay, so a lower barrier to entry, but a slightly higher monthly cost because of that insurance.
Right. And then, if we're talking about who these programs serve, the VA loan is just a massive standout. It's for a very specific and very deserving group.
Eligible veterans and active duty military.
That's right. And this is where those hidden keys we mentioned really unlock some huge savings. There are two major perks.
Well,
First, 100% financing.
100%. So literally zero down payment required.
Zero. Absolutely zero. Imagine buying a $400,000 home. That's $80,000 you don't need to have saved up.
That's life-changing for a lot of families. And the second perk.
This one is huge for your monthly budget. No mortgage insurance.
Wow. Let's put a number on that. On another type of loan, that PMI could be what, a couple $100 a month?
Easily. Sometimes more. So for that same $400,000 home, the VA borrower is immediately saving hundreds every single month compared to someone else. That's real money.
That's immediate long-term financial stability right there.
Yeah.
Huge savings, both upfront and every month.
Absolutely. But, not everyone is buying a home that fits within those standard loan limits.
Right. Which brings us to the more specialized stuff. Let's talk about the jumbo loan.
So these are for loan amounts that go above those conventional limits. Think luxury properties or homes in really high-cost areas like you see in parts of Florida.
And the structure is different, right? The sources say these aren't your typical Fannie and Freddie loans.
Totally different. They're often private equity or portfolio loans. What that means is the bank is holding on to the risk itself, not selling it off.
And that changes things for the borrower. How?
Well, they can be more investor-friendly with faster closings, but the key phrase the source uses is credit score flexibility.
Credit score flexibility. I like that. So if the number isn't the only thing that matters, what are they looking at?
They're looking at your whole financial picture, your reserves, your liquidity. They might look less at the raw score and more at your verifiable assets, your investment portfolio, the cash you have after closing.
So for high net worth folks, it can actually be a smoother process.
It's often a much more tailored approval process, yes.
Okay, so regardless of which path you go down, conventional, VA, jumbo, you still have to decide on the rate, the structure of the rate itself.
And there are two basic kinds. We should define them clearly. You have your fixed rate mortgage, which is all about stability.
Your rate is your rate. For 30 years or 15 years, it never changes.
Predictable, unchanging monthly payments. Simple. The other option is an adjustable rate mortgage or an ARM.
Right. These seem to come and go in popularity.
They do. With an ARM, you start with a lower fixed rate for a few years, maybe 3, 5, or 7. But after that, the rate adjusts periodically based on the market.
So you get a lower payment at the beginning.
But you're taking on long-term risk, volatility. You have to be really, really comfortable with that uncertainty.
Okay, that covers the menu for buying a home. But the sources get really interesting when they talk about what happens after you own the home. It's a financial tool, not just a place to live.
Yes, exactly. Mortgages aren't a one-and-done transaction, and the documents really emphasize refinancing as a core service.
And it's not just about getting a lower rate.
Not anymore. I mean, that's often the goal. A lower monthly payment, maybe switching from an ARM to a fixed rate for stability. But a huge part of it now is about equity.
So the cash out refinance, are people actually using this to, I don't know, put in a pool, or is it more about managing debt?
The sources suggest that debt consolidation is a massive driver right now. Think about it. You're using your low-interest mortgage debt to pay off high-interest credit card debt.
Which could be at 25, 30% interest.
Exactly. For a lot of people, this is a huge financial pivot. It can slash their total monthly debt payments dramatically, and the cash you pull out is tax-free. It's a powerful tool.
And it's not just for your primary home either. The sources mention financing for investment and commercial properties too.
They cover the full spectrum, from the first-time buyer to a seasoned real estate investor growing a portfolio.
And what about getting over that initial hurdle? The down payment and all those closing costs.
They talk about that specifically. They mention supporting buyers with options like 96.5% financing, which is a very low down payment. But they also mention helping with closing costs through seller and lender concessions.
Concessions are so important. People focus on the down payment, but closing costs, the appraisal, title insurance, all those fees can be thousands and thousands of dollars.
It's a huge barrier. So the ability to structure a deal where the seller or the lender covers some of that can be the thing that makes the deal possible for a buyer on a tight budget.
It really can. Okay, so after looking at all these products, this raises a big question for me. What about the myths? The messy reality of the mortgage process?
I'm glad you brought that up because they tackle that head on. There's this one article titled, "But My Neighbor Got."
Ah, yes, the classic. My neighbor got 2.5%. Why can't I?
Right, and it's a huge reality check. The sources are clear. Bankers and brokers don't just decide what your rate is. The big economic picture sets a baseline, but your individual factors are what really determine the final rate you get.
So if my neighbor's rate is meaningless, what are the top couple of factors I should be focused on to get a better rate for myself?
The material points to two big ones. First, your debt-to-income ratio, your DTI.
How much of your monthly income is going out the door to pay debts?
Exactly. The lower your DTI, the less risky you look. Second is the loan term. A 15-year fixed mortgage almost always has a much lower rate than a 30-year because the bank gets its money back faster.
So pay down credit cards and maybe see if you can handle the higher payment of a shorter loan. That's actionable advice.
It is. And they also get really relatable about the stress of the process itself. There's a whole piece on the "are we closing tomorrow" scenario.
Oh, I can feel the anxiety just hearing that phrase.
It's a nightmare. The moving truck is packed, your whole life is in boxes, and then you get that call. Closing is delayed. The source calls it internal rage.
I think that's putting it mildly.
But the point they're making is that communication and transparency are critical. It's not just a transaction, it's a major life event. You can't leave people hanging.
And the proof of that commitment comes from the success stories they share, the reviews.
Absolutely. There's one about a teacher who was, I think the word she used was overjoyed. She used the Hometown Hero Grant Initiative.
A program that gives financial help based on profession.
Right. It shows the lender knows how to navigate these specialized assistance programs to make a home affordable when it otherwise might not have been.
And then there's that incredible story about the client with downright horrible credit.
That one was amazing. Most lenders would just say no. But here, they gave him a step-by-step plan to fix the underlying problems.
So it's more like financial coaching than just lending.
It's that relationship banking they talk about. And it worked. The source says once his score hit the target, he got a pre-approval in 24 hours.
24 hours.
Okay.
And closed in how long?
Just 3 weeks, which is just remarkable considering where he started. And they even mention a staff member, Kelly Ardito, working nights and weekends to make sure he understood everything.
That's the human element. You don't get that from an algorithm.
No, you don't. And that guidance is even more important when you zoom out and look at the federal environment that controls all these rules.
Right, it's not just the local market. There are big federal forces at play.
This is critical context for everyone. The source brings up the Consumer Protection Financial Bureau, the CPFB.
The big regulator.
Heavy regulator. They're there to protect you, the consumer, by making sure the rules are followed. They're behind things like the know before you owe disclosures, making sure you know what you're signing.
Which makes their next move, something the sources specifically warn about, all the more important. This isn't just background noise, it's a policy change that could really shake things up.
Correct. The CPFB is pushing to get rid of something called the GSE patch.
Okay, you have to explain that one. What is the GSE patch?
So it's basically a temporary rule that lets Fannie Mae and Freddie Mac approve some loans with a debt-to-income ratio that's a little higher than the official legal limit of 43%.
So it's a bit of a loophole. It gives them some flexibility to approve people who are otherwise good borrowers, but have slightly higher debt.
Essentially, yes, it provides that flexibility, but the source warns that a hard deadline is coming down the pike to get rid of this patch.
And if it goes away?
Lending standards will tighten immediately, overnight. The number of people who qualify for a standard conventional loan will drop. A lot of potential buyers could be forced back to the drawing board. This is probably the single most important strategic insight in all of these documents.
So you have this huge looming policy change on one side, but on the other, the lender is promising that local personal commitment to help you navigate it.
That's their pitch. They talk about being in Coral Springs since '96, that relationship focus, and their availability, 7 days a week, 9 a.m. to 9 p.m. for consultations.
Plus claiming 24/7 availability for answers? That's a bold claim.
It is, but that's the high-touch service they're saying is necessary to get people to the finish line, especially when regulations are getting tougher.
So after all this, what does it all mean? We started with this overwhelming menu of options.
And now we have clear paths. I think the key takeaways are threefold. First, know your entry point. FHA for accessibility, VA for those incredible zero down, zero PMI savings.
Second, forget the rate myth. Your rate is about you, your DTI, your assets, not your neighbor.
And third, and maybe most importantly, the whole market for conventional loans is facing a major change with this GSE patch elimination. Everyone should be watching that.
We've explored the menu of mortgages and the huge role that personal service plays.
We have.
But the ultimate provocative thought for you to mull over is this. Considering how many borrowers right now depend on that DTI flexibility, just how much tighter will the door to homeownership get, and how quickly will that upcoming federal deadline reshape who even qualifies for a loan?
Thank you for diving deep with us today.
We'll see you on the next deep dive.